Hello. This is the 39th episode of What Would Peter Lynch Do?, which explores the wisdom of legendary investor Peter Lynch. We had a great question from one of our listeners. They said they often sees news about companies buying back their own stocks, and it seems like it's usually considered good news for stocks, so stock prices often go up. Is buyback news always good news? Is it never bad news? That's a really common observation, and it's a great question. So let's unpack this. Let's dig into what a stock buyback actually means for you, the investor.
Right.
Basically, when a company announces a buyback, they're saying, we're taking some of our shares off the market, right? So fewer shares out there. And in theory, that makes the shares that are left, well, rarer and maybe more valuable.
Exactly. That's the core idea.
Yeah.
And to really get why it's generally seen as good news, think about pizza. It's a helpful analogy.
Okay, pizza, I'm listening.
Imagine a whole pizza that represents the company's total value, maybe its profit pool, and each slice is like one share of stock.
Got it. Pizza equals company value, slice equals share.
Right. Now, say the pizza shop owner, that's the company, decides to buy back 2 slices out of the original 8. You still have your 1 slice, but suddenly it's not 1 of 8 anymore, it's 1 of 6.
So my slice got relatively bigger, even though the pizza size didn't change.
Precisely. Your ownership percentage just went up without you doing anything.
Yeah.
That's the magic of a buyback. Fewer shares means your piece of the company pie is larger.
Okay, that makes intuitive sense. Bigger slice of the pie. But how does that actually push the stock price up? What are the financial mechanics behind that?
Yeah, there are really 3 main drivers for why buybacks generally boost stock prices. First, and this is a big one, is the impact on earnings per share, or EPS.
The EPS, right? Profit per share.
Exactly. It's just the company's total net profit divided by the total number of shares. So let's use an example. Say Superhero Inc. makes $1 million profit.
Okay.
If they have 100,000 shares out there, their EPS is $10. Simple math.
Right. 1 million divided by 100,000. $10.
Now, what if Superhero Inc. buys back 20,000 of those shares? Now, there are only 80,000 shares left, but the profit is still $1 million. So the new EPS is 1 million divided by 80,000. That's $12.50 per share.
Oh, wow. So the earnings per share jumped just because there are fewer shares.
Exactly. Investors see that jump from $10 to $12.50 and think, hey, this stock is earning more now. And that naturally makes them willing to pay a higher price for it.
Okay, that's clear. EPS goes up. What's the second reason?
Simple supply and demand. Think about limited edition sneakers.
Okay, like those super rare ones.
Yeah. If only 100 pairs exist and everyone wants them, the price skyrockets, right? Scarcity drives value. Stocks work similarly. When a company buys back shares, it reduces the supply available in the open market.
Less supply.
And if demand stays the same, or maybe even increases because the company looks good, the price naturally tends to go up. Basic economics.
Makes sense. Supply down, price up. And the third reason?
The third one is more about signaling. A buyback sends a really powerful message from the company's management. It basically shouts, we are confident in our company.
How so?
Well, think about it. Why would management spend the company's cash buying its own stock unless they truly believe it's undervalued and likely to go up? If they were worried about the future, they'd probably use that money for something else, maybe building a new factory, or more R&D, or paying down debt.
Right, they play it safer.
So when they choose to buy back stock instead, it signals strength. It says, our business is doing great, we've got plenty of cash, and frankly, investing in our own stock is the best use of this money right now. Investors definitely pick up on that confidence signal.
That really clarifies things. Confidence, scarcity, and better earnings per share. It paints a pretty positive picture. And we see this play out, right? Like Apple, they're famous for massive buybacks. I remember hearing about a $90 billion announcement once. How do investors usually react to that kind of news from a giant like Apple?
Oh, with a lot of enthusiasm, usually. An announcement like that, especially from Apple, is taken as a huge sign of strength. It signals that their core business, iPhones, services, is throwing off enormous amounts of cash.
Yeah, more cash than they know what to do with sometimes.
Right. And it also signals that management believes Apple's stock price is actually undervalued compared to its real worth. That's a powerful statement. Investors hear that and think, okay, Apple's confident about future products, they have tons of cash, and buying back shares means my own shares become more valuable. That combination usually leads to the stock price going up.
Okay, let's look at some more recent examples. How does this actually look in the market day to day?
Good idea. Let's take Meta platforms, Meta. They're often buying back shares fueled by their big advertising business and all their spending on AI and, well, the metaverse.
Right.
So in late 2024, when they announced their Q4 earnings, they also announced a massive increase to their buyback program, an extra $50 billion.
50 billion, that's huge.
It is. It signaled immense confidence in cash flow. Now look at the stock price. Before that news, around February 5th, 2025, it was trading about $454.
Okay.
The very next day, February 6th, after the announcement, it closed near $471. That's roughly a 3.7% jump in just one day.
Wow.
And it didn't stop there. It climbed past $485 later that month. Investors were clearly cheering the strong ad business, the AI potential, and that huge buyback commitment just reinforced the feeling that, this is a safe bet.
Okay, Meta's a tech giant. What about a more traditional company?
Let's look at General Motors, GM.
Mm-hmm.
They used a big buyback to signal financial health, especially with all the focus on the expensive shift to electric vehicles.
Right, lots of questions about EV costs.
Exactly. So in late January 2025, GM announced a new $10 billion buyback plan, citing their solid 2024 results. Before that, January 29th, the stock was around $42.50.
And after?
The next day, January 30th, it jumped to about $45.80. That's a surge of nearly 8% in a single day.
Almost 8%. That's significant.
It really was. It helped change the narrative around GM at the time. The stock pushed past $48 in February. Investors basically interpreted it as, okay, despite the EV investments, GM is making good money and they're confident about the future. It signaled strong fundamentals.
So it definitely seems like these big, confident buyback announcements often give the stock price a real boost, at least in the short term. It's that mix higher EPS, fewer shares, plus that big confidence vote from management.
Absolutely. It's a powerful short-term signal. But, and this is really crucial, a stock buyback isn't some kind of magic bullet.
Right, not a guarantee.
Exactly. It doesn't guarantee the stock price will keep going up forever.
Right.
The company's actual long-term growth prospects, the overall economy, market conditions, those things have a much bigger impact down the road. So think of a buyback as an important indicator, maybe a piece of the puzzle, but not the whole picture.
That's a really important distinction. An indicator, not a guarantee. And, that leads perfectly into another listener question we got, which takes a much broader view. They asked, let me read it. Stock buybacks are also compared to reinvestment, right? If a company buys back and retires shares, isn't it like the money just goes up in smoke, like burning it? Wouldn't it be more valuable to use that money to reinvest in R&D or to acquire other companies to increase competitiveness, or at the very least to improve employee welfare? Because that money would actually be doing something. And they continue. Of course, Peter Lynch once said that it's better to buy back shares because those other activities are often useless and prone to bad investments. From an investor's point of view, his thinking makes sense if I'm a shareholder and only consider the company itself and the stock price. But from a societal perspective, even if that money was used on failed research, it would have created jobs and helped the economy by buying goods. From a societal point of view, wouldn't it be more meaningful to spend the money that way? Mm-hmm. Wow. That's a deep question. It really gets to the heart of a big debate.
It really does. And the listener hits on several critical points here. Let's break it down. First, this idea of money going up in smoke or being destroyed. Is that what happens?
That's the core of the first part of the question.
Well, no. The money isn't destroyed. So when a company buys back, say, $1 billion of stock, that $1 billion doesn't just vanish. It gets transferred.
Transferred where?
To the shareholders who sold their shares to the company. That cash goes directly into their accounts. And what do they do with it? They might reinvest it in other stocks or buy bonds, or maybe they spend it on goods and services or put it in the bank. So the money keeps circulating in the economy or the capital markets.
Okay, so it's a transfer of cash from the company to shareholders, not destruction. The decision-making power just shifts.
Exactly. Which leads to the second point. Reinvestment versus returning cash to shareholders. This is all about opportunity cost. A CEO with extra cash has to decide, where can I put this money to get the best return for the company and its owners?
Right. Invest in growth or give it back.
Sometimes reinvestment is absolutely the right call, especially for growth companies. Think about, say, Tesla back in 2015. If they'd spent their money on buybacks instead of building gigafactories and funding R&D, they wouldn't be the company they are today. For them, reinvestment was essential for survival and growth. Buybacks would have been foolish.
So for young, growing companies, reinvestment is key.
Often, yes. But for more mature companies, maybe in slower-growing industries, buybacks can be the smarter move. What if there just aren't any great investment opportunities? Maybe R&D is unlikely to yield big breakthroughs. The market's saturated, or potential acquisitions look too expensive or risky.
That's where Peter Lynch's point comes in.
Exactly. Peter Lynch warned about what he famously called diversification.
Diversification, I like that.
Yeah, it's brilliant, isn't it? It's when companies, desperate to show growth, make silly acquisitions in businesses they don't understand, often destroying value. Peter Lynch saw buybacks as a much wiser use of cash than that kind of nonsense, as he put it. Also, if management genuinely believes their own stock is dirt cheap, significantly undervalued, then buying it back might actually be the best investment they can make, better than mediocre R&D projects or risky expansions.
So in that case, the buyback is like saying, we can't find anything better to do with this cash right now. So here, you shareholders take it back. Maybe you can find a better investment.
That's a good way to put it. It's an admission that external opportunities aren't compelling, or that their own stock is the most compelling opportunity. Now, the third part of the listener's question, the whole of society perspective. This is really insightful.
Yeah, the idea that even failed R&D creates jobs and economic activity.
Spot on. Even if an R&D project fails, it employed scientists, engineers, support staff. The company bought equipment, materials. Knowledge was gained, even from failure. These are positive social externalities.
Things that benefit society beyond the company itself.
Right. A stock buyback, on the other hand, primarily transfers wealth to shareholders. It might boost asset prices, but the direct impact on job creation or immediate economic stimulus is generally smaller. This really touches on a fundamental debate: shareholder capitalism versus stakeholder capitalism.
Okay, what's the difference there?
Shareholder capitalism, dominant in the U.S., basically says the company's main goal is maximizing profit for its owners, the shareholders. Stakeholder capitalism, more common in, say, Europe or Japan, argues the company has responsibilities to all stakeholders, employees, customers, suppliers, the community, and should prioritize long-term stability, maybe R&D, employee well-being, even if it doesn't maximize short-term profit.
So two different philosophies on what a company is for.
Exactly. There's no single right answer globally. It depends on societal values. Buybacks transfer capital, they don't destroy it. But the argument that using that money for R&D or investment creates broader societal benefits like jobs and innovation is very strong and valid, a complex trade-off.
That's a really helpful breakdown. So going back to that transfer idea for a second, when you say a buyback transfers capital to shareholders, just to be crystal clear, does that mean the profit comes because the stock price goes up? Is that the mechanism of the transfer?
Yes, that's a huge part of it, especially for shareholders who keep holding the stock. Your understanding is right on track. Think about it in two ways. First, there are the shareholders who actually sell their shares back to the company during the buyback.
Okay, the sellers.
For them, it's a direct cash transfer. If Apple buys your share for $180, that $180 cash literally moves from Apple's bank account to yours. Simple transaction.
Got it. Direct cash.
Second, there are the shareholders who don't sell, who continue to hold their shares. For them, the value transfer is indirect, primarily through that stock price increase you mentioned.
And why does the price go up for them?
Two main reasons we touched on. One, their ownership percentage increases. Remember the pizza. Fewer slices mean your slice represents a bigger chunk of the whole company. Two, the earnings per share goes up. Same profit spread over fewer shares means more profit attributed to your share.
Right. Bigger slice, more earnings per slice.
Exactly. The market recognizes this increased ownership and higher per share value and bids the stock price up accordingly. So the transfer of value to holding shareholders happens through this appreciation in their stock's price.
Okay, that makes total sense now.
So yeah, the statement, a stock buyback has the effect of transferring capital to shareholders, covers both the direct cash to sellers and the indirect value realized as a price increase to holders. You nailed it.
Great. Thanks for clarifying that. Now, since we're focusing here on folks who invest in stocks, let's pivot back to the company's perspective a bit. I get how buybacks benefit shareholders, but why do companies do them? Surely it's not just altruism towards investors. There must be strategic advantages for the company itself, right?
Oh, absolutely. Companies have several very practical strategic reasons for buying back stock, beyond just making shareholders happy. First, it's a tool to manage their earnings per share and improve other financial metrics.
The EPS boost we talked about earlier?
Right. By reducing the share count, they can make their EPS look better, which can make the company seem more efficient or profitable than it might otherwise be. This can also lower the price to earnings, or PE ratio, making the stock look cheaper or more attractive to certain investors, like value investors. It can even help management hit bonus targets tied to EPS.
So a bit of financial engineering, potentially?
It can be, yes.
Yeah.
Second, and this is very common, companies buy back shares to offset the dilution caused by employee stock compensation.
Like stock options or RSUs.
Exactly. Tech companies especially grant a lot of stock to employees to attract and retain talent. This creates new shares, which dilutes existing shareholders. So companies often buy back shares on the open market, creating what's called treasury stock, specifically to have shares available to give to employees without issuing brand new ones. It neutralizes the dilution.
Ah, okay, so it keeps the share count stable despite stock grants.
Precisely. Third, buybacks can help stabilize the stock price and provide downside support. When a company has an active buyback program, the market knows there's a consistent buyer out there for the stock. This can act like a safety net, especially during market downturns. It provides buying pressure that can prevent the price from falling too sharply.
Like a floor under the price?
Sort of, yeah.
Yeah.
It builds confidence for long-term investors. Fourth, it can actually be a defense against hostile takeovers.
How does that work?
If another company tries to buy up enough shares to take control against the current management's wishes, a buyback program reduces the number of shares available for them to buy. It makes a takeover harder and more expensive.
Clever. Makes the target smaller.
And finally, it's often seen as an efficient use of surplus cash. If a company is just sitting on a huge pile of cash earning very little interest, it can actually drag down certain financial ratios, like return on equity, ROE. So if there aren't compelling investment opportunities, using that sleeping money to buy back shares, boost EPS, and return capital to shareholders is often considered a smart capital allocation move.
That's a really comprehensive list of strategic reasons. It makes it much clearer why companies use this tool so often. So for us investors, the takeaway seems to be, when you see a buyback, don't just cheer automatically. Ask why. Are they managing dilution? Defending the stock price? Signaling a lack of growth options? Understanding the why behind it seems crucial for figuring out what it really means for the company's future. Okay, this leads me to the flip side again. I always kind of mentally filed buybacks under good news. But based on this discussion, can they actually be bad news sometimes? A negative signal?
That's exactly the right question to ask. And yes, absolutely. A buyback isn't always positive. Sometimes it can be a sign of trouble, maybe even a scream of desperation, depending on the context.
A scream of desperation. Wow. Okay, when might that be the case?
Well, there's several red flags to watch out for. First, probably the biggest negative signal is when it suggests there's no more room to grow. It could mean the company just can't find any promising investments for the future, no exciting R&D, no new business lines, no worthwhile expansions. Their growth engine might be sputtering out.
So they're buying back stock because they literally have nothing better to do with the money.
That can be the implication. For investors looking for long-term growth, that's obviously disappointing. It suggests the company might be stagnating.
Okay, lack of growth opportunities. What else?
Second major red flag, excessive buybacks funded by debt. If a company isn't using its actual profits, but is instead borrowing money, taking out loans, or issuing bonds just to buy back stock, that's usually very dangerous.
Why dangerous?
Because it loads the company up with debt. It suggests management might be obsessed with boosting the stock price in the short term, even at the expense of the company's long-term financial health. They have to pay that debt back with interest. It's a risky gamble.
Right. Using debt adds financial risk. What's third?
Third, buybacks can be used as a smokescreen to hide poor underlying performance.
How does that work?
Remember how buybacks boost EPS by reducing the share count? A company's actual net income, its total profit, could be falling. But if they buy back enough shares, they can make the EPS look like it's flat or even growing.
Deceptive.
It can be. That's why you always need to look at the trend in total net income, not just EPS. If profits are down 10%, but they cut shares by 15%, EPS might look up 5%. It masks the real problem.
Good point. Always check total profit growth. What's number 4?
Buying back stock at a historical high price. This signals poor judgment by management. If they're spending billions on buybacks when the stock is already arguably overvalued, they're essentially buying high with shareholder money. That destroys value when the price eventually corrects.
Means management isn't good at valuing their own company?
Or they're caught up in market euphoria. Either way, it undermines trust in their capital allocation skills. Think about companies buying back stock hand over fist at the peak in late 2021, just before the market turned down. Not a good look.
Definitely not. Okay, and the last red flag.
Finally, buybacks can sometimes be driven by the short-term self-interest of management. Many executive compensation plans include bonuses tied to hitting certain stock price levels or EPS targets within a short time frame, like a year.
Ah, so a buyback is an easy way to boost those numbers and trigger bonuses.
It can be the easiest way, yes. Easier than achieving genuine long-term business growth. This creates a potential moral hazard where management might prioritize actions that benefit them personally in the short term, even if it's not the best long-term strategy for the company, like maybe sacrificing R&D for a buyback.
Okay, that's a worrying possibility. So, quite a few potential downsides. It sounds like we really need an investor's checklist when we hear about a buyback, like key questions to ask ourselves before deciding if it's good or bad news.
Exactly. A mental checklist is a great idea. When you see a buyback announcement, pause and ask. First, where's the money from? Is it coming from strong operational cash flow, which is good? Or is it funded by new debt, which is a potential red flag?
Okay, source of funds, check.
Second, what is the company's growth stage and prospects? Is it in a rapidly growing industry with lots of opportunities? Or is it a mature, maybe even declining business where buybacks might signal stagnation?
Growth context, got it.
Third, what is the current stock price level? Is the stock trading near a historical low, suggesting it might actually be undervalued? Or is it near a historical high, raising concerns about buying high?
Price level makes sense.
And fourth, critically, is the company's total net income actually growing? Don't just look at the boosted EPS number. Check the underlying business profit trend.
Right, look past the EPS trick.
If you run through those questions, you get a much better sense of whether the buyback is a sign of strength or potentially a warning sign. Remember, it's a double-edged sword. A buyback from a healthy, undervalued company, great signal. From a struggling, indebted company buying at the peak, alarm bells should ring.
That checklist is super helpful. It really forces you to look at the context. But that raises another question for me. If these negative signal buybacks happen, why don't we seem to hear about them much? You mostly just hear the positive spin. I can't recall seeing many headlines saying Company X buyback is actually bad news.
That is a very, very sharp observation. And you're right, you almost never see news explicitly framed that way. There are a few key reasons for that. First, think about how news often works. Media tends to report on immediate phenomena.
Like the stock price jumping right after the announcement.
Exactly. When a buyback is announced, the stock often does get a short-term pop, so the headlines naturally focus on that immediate visible effect. Stock surges on buyback news. It's simple, tangible news.
Okay, so the immediate effect is usually positive or seen as positive.
Right. But the negative consequences of a bad buyback, they usually unfold much more slowly, often over months or even years.
Yes.
Well, if it was funded by debt, the problems might only surface later if interest rates rise or profits fall, making the debt hard to handle. If the company missed a growth opportunity by not investing in R&D, that lost future value isn't immediately obvious. And if they bought back stock at a peak price, it might take a long market downturn for everyone to realize, wow, they really overpaid back then. Because these negative effects are delayed and harder to pin directly on the buyback decision made months or years earlier, they don't make for easy headlines.
Ah, the negative impact is slow and diffuse.
Exactly. Plus, companies themselves will never frame a buyback negatively. They'll always spin it positively. They'll say it's to enhance shareholder value or shows confidence in our outlook, even if the underlying reason is less rosy. They control the initial narrative.
That makes sense. The immediate news is positive, the negative stuff is slow, and the company spins it well. But are these bad buybacks actually common then, or are they rare exceptions?
Oh, they're much more common than you might think,
Mm-hmm.
especially if you look at the aggregate behavior of companies across market cycles. It's actually kind of ironic. Research generally shows that companies, as a group, are pretty terrible market timers with their own stock.
Really? They buy at the wrong times?
They tend to, yes. They generally buy back the most stock when prices are high, near market peaks. And they buy back the least stock when prices are low, during market crashes.
So they buy high and sell low, or rather, stop buying low.
Exactly the opposite of what you'd want to do. During bull markets, companies are flush with cash, feeling confident stock prices are high. That's when buyback activity explodes. But in hindsight, many of those turn out to be poor investments, buying shares at peak valuations. Think about all the buybacks in, say, 2021 again.
Right before things cooled off.
Precisely. Conversely, during a bear market or a crash, when their stocks are genuinely cheap, companies often get cautious, hoard cash, and slash buyback programs just when it would be the best time to be buying aggressively.
So they miss the bargains.
They often do. So looking at that pattern, you could argue that Bad news buybacks, particularly the buying high kind, are actually quite frequent, especially near the end of market booms. It's just that the negative consequences aren't immediately apparent or reported as such.
That's fascinating and a bit counterintuitive. So, as investors, what's the takeaway? How should we react to buyback news knowing this tendency?
The key takeaway is, don't just follow the headlines or the initial excitement. Be a critical thinker. Consider the context. If you see a company announcing a huge buyback when the market is already sky high and everyone's euphoric, maybe be a little skeptical. Ask yourself, are they paying too much here? Is this sustainable?
Healthy skepticism at market peaks.
Right. Conversely, if a financially strong company steps up and announces a significant buyback during a market panic, when everyone else is selling and pessimism is rampant, that could be a really powerful signal of genuine confidence. That's management putting its money where its mouth is, believing the stock is truly cheap.
Look for bravery in downturns.
Exactly. Ultimately, a stock buyback is just one signal. Its true meaning depends entirely on the company's situation, the market environment, and the reasons behind it. You have to interpret it within that broader context.
That's a really valuable perspective. Context is everything. Okay, let's bring it home by talking about the man himself. Please explain what Peter Lynch thought and said about this topic. And if other famous investors had strong opinions, let's hear those too.
Absolutely. Peter Lynch was actually a big fan of stock buybacks, a really enthusiastic supporter. In his classic book, One Up on Wall Street, he explicitly listed the company consistently buys back its own shares as one of the characteristics he looked for in a potentially great stock, what he called a perfect stock.
So it was high on his list. Why did he like them so much?
Several reasons. First, he saw it as, and I quote, the simplest and best way a company can reward its investors. Simpler and often better than dividends.
Why better than dividends?
Well, dividends are taxed immediately as income for the shareholder. But a buyback increases the stock price, leading to capital gains, which are often taxed at lower rates and only when the shareholder actually sells the stock. So potentially more tax efficient. Second, like we discussed, Peter Lynch saw it as a strong signal of management's confidence. He felt if the company believed in its own future, investing in itself by buying back shares was a logical and positive sign. Proof they had faith.
Okay, confidence signal. And what about that diversification idea?
Ah, yes, that was crucial for him. Peter Lynch was famously wary of companies making dumb acquisitions or expanding into businesses they didn't understand just for the sake of growth. He saw so much value destroyed that way. So he argued that using surplus cash to buy back shares was often a much wiser, safer choice than potentially wasting it on foolish expansion or nonsense acquisitions. It prevented management from making costly mistakes with shareholder money.
So for Peter Lynch, good for shareholder return, good signal of confidence, and good because it stops companies doing dumb things with cash.
That sums up his view pretty well. Very positive overall. Now, Warren Buffett also generally likes buybacks, but he's much more conditional.
More cautious than Peter Lynch.
Yes, his emphasis is heavily on the price. For Buffett, a buyback only makes sense, is only justified, if the stock is trading significantly below its intrinsic value.
Below its true worth.
Exactly. If the company buys back shares at a price above intrinsic value, Buffett argues it actually harms the remaining shareholders by destroying value. The price paid is everything to him. He's quite pointed about it. He once said something like, when you are told that all repurchases are harmful, you are listening to either an economic illiterate or a silver-tongued demagogue. Strong words.
Wow, he doesn't mince words.
No, he doesn't. But he's also critical of how many companies actually do buybacks. He dislikes that tendency. We talked about companies buying more when prices are high and less when they're low. Buffett says his approach is the exact reverse. Buy when it's cheap.
So for Buffett, it's a powerful tool, but only if management is smart about value and the price is truly attractive.
Precisely. It's a sophisticated capital allocation decision that requires discipline and a focus on intrinsic value.
Okay, so Lynch was broadly positive, Buffett conditionally positive based on price. Are there prominent critics too?
Oh yes, there are definitely critical views. Jeremy Grantham, another well-known investor, is generally more skeptical. He's sometimes characterized buybacks as akin to stock price manipulation, preferring the straightforwardness of dividends if a company wants to return cash.
Manipulation, that's a strong charge.
It is.
Yeah.
And then you have broader criticisms, often from politicians or economists, echoing the listener's earlier points. They argue that the vast sums spent on buybacks could be better used for things that benefit the wider economy more directly, like investing in R&D, building factories, increasing wages, or worker training.
The societal benefit argument again.
Right. Critics also argue buybacks can worsen income inequality since stock ownership is concentrated among wealthier individuals, and that they primarily serve management's self-interest, especially when bonuses are tied to EPS or stock price targets.
So quite a range of opinions, even among experts.
Definitely. But the key figures like Peter Lynch and Warren Buffett see clear benefits, just with different emphasis. Peter Lynch highlights it as often being the least bad option compared to foolish spending, a pragmatic view. Warren Buffett sees it as potentially the best option, but only under the strict condition that the price is right, a value investor's view. Both see it as a potentially smart way to return capital, but the how and when are critical.
That's a fantastic summary of the different perspectives. It really shows there's no simple answer, and investors need to think critically. Okay, for today's Lynch quote, Peter Lynch famously said, "Know what you own and know why you own it." While that applies directly to picking stocks, it also connects deeply to our discussion today about understanding why a company is doing what it's doing, like a stock buyback. It's not just about owning the stock, it's about understanding the company's actions and motivations. This principle, I think, extends beyond investing. Knowing the why behind actions, whether your own or others, is crucial wisdom for life too. That's all the time we have for today. See you next time on What Would Peter Lynch Do?
Thank you for joining us today. Have a nice day.